everyone. Welcome back to the Trading Room. I'm Shane Vernier, and this is FOMC Live. Today, we're going to have the latest press conference from Jerome Powell. We're going to have all the details of the breakdown on what is probably sort of a ho-hum move. We expected a quarter-point rate cut. We've been covering it for the last 2 weeks. We got it. We got a quarter-point rate cut today. It was a split decision in one of those deals where, hey, some folks wanted a rate cut. Some folks wanted to hold them static. Eventually, the Doves won the day, and in many ways, they were trying to sort of establish themselves in the next iteration of the Fed. So what did today's meeting mean? What does any of it mean? We're going to break all that down for you and more. We've also got some key markets. Euro USD, we're going to start with US 100, Great Britain Pound USD, Dollar CAD. Those are biggies right off the bat. We're also going to look at gold, US 500, and the US dollar Japanese yen when we do some live scalping during the presser, which is coming up in about 10 minutes. So it's good to see everybody back in the room out in YouTube land. Donovan, good to see you. Don, always a pleasure. Let's see. T Marina, good to see you. T Marina. Treehawk, good to see you. Tree, Steve Francis, Bobby Bob, Gordon Williams over there in the How to Trade community. Welcome one, welcome all. If you have any questions, try to ask them, try to get them in. I know on these streams it's sort of difficult to answer questions, but I'll do the best I can to help out. Interesting trading day. Right now we're seeing stocks rally. We're seeing the dollar sort of, do a little bit of an about face. We're losing steam on the USD. We predicted a weaker dollar, and I think that 2026 is going to be the year of the weak dollar. So let's go ahead and get started and get through our fundamentals before we get into our live trading. Remember, if you want to trade anything that we talk about today, be sure to check out switchmarkets.com. Bring your ambition into focus, a regulated broker built to help manual and algorithmic traders thrive. So if you have any questions at all, be sure to reach out to the support team over at Switch Markets. They'll get you up and running. They've got a lot of bonuses, a lot of credit bonuses, lots of different ways that you can get involved in the market. So let's get right out to price action here. Euro US dollar. This is something we have a lot of folks that are in the live chat saying, Shane, what do you think about the Euro US dollar? Well, if you followed our picks of the week over at Switch Markets, the video drops right before the Tuesday UK session. We covered it. Now, we talked a lot about the Euro USD, and right there, this was our 920 EMA crossover on the daily time frame. You're going to have more success trading larger time frames with crossover strategies. Bottom line, they're more expensive to trade. Your stop losses are bigger, but you're going to be in great position to catch a move like we caught today in the Euro USD. So right now for the day, we're up about 0.38%. You'll notice this bullish signal essentially was going to be a bid, and that came across last Monday on December 1st, so a week ago Monday. There was your bid. Your bid was 116.07. Okay, you had a nice big rally right there. Now what are we talking about? Pull back to our moving averages, and now we've gone much, much higher on the day. So why did we go higher? Rate cut. That was really the big reason why. A lot of folks thought it was already baked in. Apparently, it's not already baked in. So we've got a pretty good long situation here. If you're on that position trade from the picks of the week, fantastic. Well done. If you're not in already, your trade location is going to be difficult. You're going to have to make a decision on what you want to do with your money and how you want to spend it. This right here is your 30-minute bar. There's your Fed meeting. What can we do to trade it right this minute? Well, for me, I would just keep going down in duration. So right there's a 5-minute chart. This trade's coming right back down to us, and something like this could be very good. Spike low right there, spike high. So what do we want to do? Probably want to step up and bid somewhere right around 65. So let's go ahead and take a shot at this. We'll go paper trading. Remember, the leverage that I use and everything that we do here on your paper trading is just that. It's paper. It's fake. It's not real. We're probably going to do maybe some live tick scalping tomorrow with real money. I'm welcome to the challenge, but for right this minute, we are going to do this. I'm going to take my entry point right here. We're going to put a buy limit order right around my 38% retracement on the 5-minute, and let's go ahead and we'll send them. So right there is going to be, we're playing for about $10 a pip. We've got a nice bid signal right around our 38% retracement, which is in fact right off of our Fed range. So our Fed range, spike low. Now we're coming off. We're sort of correcting. Are we going to get filled? Aren't we going to get filled? This might be a pretty good little scalp here. Right here, we've already been hit and not filled. Let's see if we can actually get a fill here and maybe play rotation back up to this 70 level. Be a nice tight little scalp, maybe a little 5-pip scalp, something like that. So our entry point's right there. Let's take our take profit. Yeah, let's take it right up to about 70, 71, something like that. That would be our take profit, $50. Our stop loss, let's put it right down in here somewhere beneath the 50% level. Run a nice 1-to-1 risk versus reward ratio and see if we can get a nice little trade to start us off with. Pretty good stuff. We should already be long. We haven't got filled yet. You're going to run into that a lot when you're trying to trade something like a Fed meeting. Now, the beauty of trading a 5-minute chart with Fibonacci's is if we get hit, if we do not get filled, if we do not get paid off on this trade, it's not the end of the world. My leverage is very, very small in this trade. We'd probably be looking to trade probably 5 times that leverage. You'll notice that we didn't get filled, and now we're starting to see the bounce. So let's let that simmer for a minute and get on out to the price action after this important press conference. So this is the headline. The divided Fed approves the third rate cut this year, sees a slower pace ahead. So sort of a hawkish rate cut. Interesting to see if these markets can actually hold their water when Jay Powell begins to speak. It's going to be fascinating to listen to what he has to say today. Remember, I had Jay Powell quitting by the end of the year. He proved me wrong. So God bless you, Jay. You're a real trooper. You stayed the course. Well done. He's out. He's gone. He's what I would akin to a lame duck president. He knows he's gone, and when his term's up, so are many of the other FOMC members. There's about 12 of them that are going to be up for review, and that's in February. So when we look at this, okay, the Federal Reserve split over whether its priorities should lie cut in a key interest rate, but signaled a tougher road ahead for further reductions. That's all complete nonsense. This is why they're calling it a hawkish cut. That's BS, because you're going to have a new Fed chair. You're going to have a new FOMC that's going to be out front next year. So right here, breaking, Fed still forecasts just 1 rate cut for next year. I'm going to go on record as saying that's complete hogwash right now. You're going to be down around 2.25% to 2.5% by this time next year. I'm willing to wager on it. Why? You're going to have a brand new Fed making decisions. You're going to have a tremendous amount of pressure from the Trump administration. They're going to cut rates, maybe not in Q1, Q2, Q3, Q4. They're going to cut, and they're going to cut aggressively. That's probably where I'm going to put my money. So something to think about there. We're watching sort of the media spin this around and say, oh, there's a tough road ahead. No, there isn't. It's very simple. They're going to have to cut interest rates to support the jobs market. It's that simple. The Fed has a dual mandate. 2 things the Fed needs to do, and 2 only. I don't care about public relations. I don't care about the climate. I don't care about anything else. 2 things the Fed has to do. Promote maximum employment. That's number 1. Number 2, promote pricing stability. Inflation, way too high. We all know it. The problem is it's entrenched. It's not going anywhere. The Fed, maybe by signaling that they're not going to cut as much next year, is trying to provide some confidence in that pricing stability. The bottom line is this: the jobs market, we're going to find out next week how bad it is. A lot of us think it's really, really bad. We're going to be interested in exactly what that means for 2026. I say it's rate cuts. I say it's rate cuts across the board. That's my own personal opinion. You're free to disagree. But definitely. So what we're watching right now is, how is this going to impact the market? Well, there's lots of different ways that it can impact the market. We're going to talk about the Great Britain Pound USD in just a second. Week 50, today was the day. BOC held interest rates static earlier this morning. Crude oil inventories, all this doesn't mean much. What does this mean? Mortgage rates sort of firm means that they believe, the long-term lenders believe that interest rates are going to sort of stay where they're at for a while. I don't believe that at all. How does the Fed impact the Forex? A dovish Fed means what? It's bearish for the U.S. dollar. Bearish for the U.S. dollar. Hawkish means it's bullish for the U.S. dollar. Theoretically, this is a hawkish rate cut. So we should see a correction out of the U.S. dollar right now. Our Euro USD play is getting hit a little bit. We're going to go ahead and let that play out. It looks like we're going to get wiped out, but that's okay. Real tight stop loss there. So does the U.S. dollar make a comeback as Jay Powell speaks? That's what we all want to know. What happened today? Rate cut is dovish. That's going to be bearish for the USD. But there was hawkish overtones, meaning there's not going to be as many rate cuts for 2026. I'm interested to see how the markets digest this. Right now, we're seeing the U.S. dollar sort of come back a little bit. We've got a sort of I would call it a very stiff or a very hard stop loss. We're going to put that right there, right around 54, a flat 1-to-1, and I'm more than happy to get stopped out here. I'm not too concerned about it if that is the case. So that's a good look at the Euro USD. That's exactly what's happening with our Fed. It's a dovish move, but the overtones are hawkish. So you definitely want to keep an eye on that. US 100 pullback zones are going to be down around 25,000. I covered this in the picks of the week as well. That's going to be a pretty good level to buy. I don't think we're there yet, not even close. Great Britain Pound USD. This is interesting. Initially, we moved a bit higher. Now we're retracing. I've got a sell limit order right beneath our 62% retracement at 134.44ish, right in that zone. I think that is a bang up a resistance zone, especially for this time of year. I'm absolutely fascinated by what we get there. Interesting stuff. Dollar CAD. We've got a limit order here. We've got a dollar CAD Right there, looking at bidding right above 62%. Essentially, these are the same trades. The only difference is going to be the timing. All right, here comes Chair Powell coming at you somewhere. I'll find the right screen. Let me go ahead and turn the sound on and make sure that we can all hear it. Should get a little bit elevator music. And it's tough talking over Jay, so we're going to go ahead and just roll that. We're live. This is going to be an interesting meeting. We don't really know what we're going to get out of Chair Powell. Probably a long face. I think he's going to look like his dog just died. If you guys can hear it, give me a thumbs up.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually
tight scalp,
cooling,
we're out.
and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market
Good to see
Committee
Arshad.
decided to
Welcome.
lower our policy interest rate by 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year.
Wow.
And edges down thereafter.
You cannot raise interest rates.
Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs.
Working our crossover.
In contrast, disinflation appears to be continuing for services.
Gold crossover, 1 minute
Near-term
chart.
Measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people.
How's that going,
At
Jay?
today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation.
Yeah.
There is no risk-free path for policy as we navigate this tension between our employment and inflation goals.
We don't know what to do.
Case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level.
That's not true.
Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Yeah, I mean, a very long statement. Spent a lot of time on the repo operations, which is a way that they juggled that.
Thank you, Howard Schneider with Reuters. Just first turning to the statement.
Long
just
statement.
To be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks.
Chop City.
Which points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and it
really like the 116.33 area
that, AI
for the Euro USD.
Centers
if we get that,
AI has been
it's a pretty good area.
Business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr.
Gold
Chair.
coming off.
Here. You had previously described rate cuts in terms of a risk management
stocks
framework,
giving back.
Kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have. If you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
It's always the same. We're well positioned. We're well positioned. No, you're not.
You have a whole lot of
No, you're
big
not.
increase in the growth numbers.
Unemployment's at
but not a big
4.5.
decline
Inflation's
in the
high.
Employment numbers. And Is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
How can that be a good thing? If the economy grows and the markets go up, but unemployment spikes as well, you're in trouble. You're seeing a consolidation of wealth.
Was clearly very
That's
divided.
the worst thing I've ever heard him say.
Dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before,
Look at the Sol USD.
The situation is that our two goals are a bit in tension, right? So, interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk.
I see it as a bid.
Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the two parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had.
Tight market,
14 years
Solana.
at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support.
9 out of 12.
It's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see, and we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that
1 minute buy right here in the US 100,
careful,
920
particularly
crossover.
The household
Interesting.
Survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor. In the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting.
He's passing the buck. I mean, they know damn good and well they have data.
By the time of the January meeting. So we expect to see a lot.
You have
more
plenty of data.
I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents
US 100 1 minute potential bid?
Either to the Fed's communication and the messaging around
They've got
the policy
data.
going forward?
They've been looking at that data for
I don't
months.
feel that we're at that point at all. I don't. I would say again, these are good, thoughtful, respectful discussions.
All right, we're
You hear
long.
people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read.
Hope.
But in this situation,
Now he's
you have-
hoping.
You have competing.
Got a little one-to-one
If you
scalp
look
going
if you
here.
look through the SEP, you'll see that
US 100 on the
a very large
rally.
number of
See how we
participants
do.
agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing?
Incremental.
What's the timing of them?
Incremental moves at a medium
it's a very
pace.
challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Jay's already scouting out his next job.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
Watching this gold.
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3 is not a big data set, but you're
Nice little move there. We'll see if we get a breakout.
3 cut times in the 90s.
There it is.
If I could follow up,
Looking for 25, 70-ish. See how this develops.
The statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral.
A broad range of plausible estimates of neutral. What in the hell does that mean?
Or to only tick up 1 or 2.
A broad range of plausible estimates of neutral.
Any kind of a sharper downturn, which we haven't seen any.
Get a little runner going
evidence
here.
At the same time, policy is still.
I like that Great Britain pound play, but it's up there a ways now.
And we feel like we have made progress this year in non-tariff related inflation.
Wanted that pullback and didn't get it.
As tariffs come through, as they
Okay,
flow
gold's
through,
starting to give us a
that'll
chance.
show through next year.
Let's have a look.
But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were
512
right or not.
Eli. Trading news events is risky. Yes, it is. This is hard. This is hard stuff. That's why we're using our indicators. We're staying patient. We're doing the best we can.
A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down to mean that, there wouldn't be a cut now.
Pretty good little move right there, though.
Instead. So
Not bad.
It'd be good to get a sense of why did the committee decide to move today rather than to move
There's
in
your bid.
January instead? Thank you.
Right. So
Because we're under
October, I
pressure.
said, that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about
Here we
it
go.
that way, but I
Gold.
was careful to say other
This
people
could be
look
good
at it
right
differently.
here.
So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I
All
think
right,
you
let's
can say
send
that
them.
the labor market has continued to cool gradually, maybe just a touch more gradually than we thought.
Wow, that's a big position.
In terms of inflation, it's come in a touch lower.
Stop loss will be right down
And I
here.
think the evidence is
Swing low right
kind of
there.
growing that what's happening here is services inflation coming down and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the
Oh, we
story,
got it.
and so
We
far
got
it's only a story
this
that
wrong here.
This is that the goods inflation, which is really the source of the excess at this point, almost
This is more realistic.
More than half the
How
source
about
of the
that?
excess inflation is goods, is tariffs, and you've got to
Stop
say
loss
that,
right
so what
beneath
do
the
we
swing
expect for
low.
tariffs? And I would say that is to some extent down to looking for broader economic, heat.
Something
do we
like
see
that.
A hot economy? Do we see constraints?
Still
do we
way
see
too much leverage.
What's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things.
It looks like we went up and
we
got
say
filled on our
that
US
this
100
was a decision to
trade.
make. It obviously wasn't
Can't beat that.
unanimous, but overall that was the judgment that we made. And that's the
Solana
action we
catching
took.
some bids.
Just on the ample reserves point, how concerned
There's your move.
were people around the table about some of
Interesting.
the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September,
What is an overnight
the
reverse
rate started
repo?
to tick up within the range, right? And it ticked up almost
The
all way
overnight
to,
reverse repo
interest
facility.
reserve balances. There's nothing wrong.
They serve
with that.
coffee over
What
there?
that's telling you is that we're
How's the
actually
service?
in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month.
Wow.
So that's a small part. That's going on. It's also happening in the context of a temporary few month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew. Thanks, Mr. Chairman.
Key level right there, Gordon. If we break above that, we could get our sell up there.
Conference before an important Supreme Court.
Pretty good little trade right
hearing
there.
this month.
Let's scratch
Can you
it.
talk about how you're hoping the Supreme Court
Take the money and
will rule?
run.
And I'm just curious why the Fed's been so reticent on such a.
This was a good one. How about
It's
Solana?
something
Solana
I
moving
would
higher.
address here, Andrew.
They're betting against the dollar, everybody.
We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant of that. I'll give you
That
a
right
public
there's the
comment.
dip we wanted
Thanks.
in the Euro
I know
USD.
that means I get 3 questions,
No,
but
just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I
No.
don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our two goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to take a balanced approach to to the two things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now.
Maybe selling 117s here in the euro.
We haven't made any.
This is the one I want.
January, but as
This one right here is the one I
think we're
want.
well positioned to wait and see how the economy.
This one too.
performs.
I would like this as well. Those two trades are really strong.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the
Nice little
inflation
920 there in
expectations,
gold.
has come down in your SEP report.
Beautiful
Do you
920
see the
there.
tariff price increases
Boom.
as passing through in the next 3 months? Is it a 6-month process that
And
we're looking for
Solana
that to
moving
end?
higher.
Because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then they start to take effect, and then it takes some months.
Silver.
Goods may have to be shipped from other parts of it may take, quite a while for an individual tariff to take its full effect. But once
See if
it's
we can
had
get
that
in on this
effect, then the
silver
question
action to
is,
the top.
Isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is, but call it the first quarter or so of next year should be the peak, and from here it shouldn't be big. It should be a couple tenths or even less than that.
Should be a very
Really
tight scalp
have
to the
precision
top
on
side
this.
here.
And after that, again,
Pretty
if there
good
are no
entry
new
on silver to the
tariffs
long,
that are
though.
announced,
5-minute
take
crossover.
9 months to get fully
That's
in.
a pretty good one.
9 months is also an estimate. Then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Mike.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
Would love this pullback in
So
silver.
we're looking at the real economy and focusing on that. And you have
The
you've got
real
to look at
economy,
when
not the one you
bonds
guys
move
look
around,
at.
You've got to look at why they're moving around. If you look at inflation
This guy's
compensation,
hilarious.
it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent. Once you get out past the very short term now, break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people,
great question,
instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation.
That's called entrenched inflation, Jay.
So
entrenched and
that's what's
embedded
going on.
higher
And so the
costs
best thing we
is
can do
entrenched
is
inflation, and
restore
you guys did
inflation
it.
to
You did it after
2%
COVID, and you
goal,
know it.
and our policy is-
Just tell
is
the
intended to do
people
that.
you did
But
it.
also have a strong economy.
God,
Real wages are
it's
going up.
frustrating
Where
listening to this
people
guy
are getting
talk. It's
jobs
too much
and-
almost.
And earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive. So nominal wages are higher than inflation for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control.
We're working
also support
hard.
the labor market and strong wages.
We took our private
that
jets
people
to the
are earning
meeting,
enough money
had a big
and
lunch,
feeling economically healthy.
chewed
again.
the fat. We're working hard.
Victoria.
Give me a break. We're working hard. Shut up.
Hi, Victoria Guida with.
This guy needs to resign. We
Just
need
to
some fresh
follow up
blood
on
in
that,
there.
I mean, this is now the third time that you've cut this year, and inflation is around 3%. So is the message that you're
guy's the
sort of
limit for
trying to send
silver.
with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now,
That's
supply
called
of work is also on the way
stagflation, and
down,
you
so
know it.
The unemployment rate hasn't moved that much, but,
Stagflation. Say it.
It's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs. That's causing the most
It's
of the
really
inflation
tariffs.
overshoot.
It's really
And we can
tariffs.
think of
And the
those
truth
as
comes out.
likely in the
We've
current
blamed a lack of
situation,
data.
is
We've
likely
blamed
to be
tariffs.
One-time pricing.
This is a
Our job
joke.
is to make sure that it is. And we
Get
will
him
do
off
that
of
job.
here.
But
Next
right
question,
now,
that's
you've got this
it.
difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was
I
just
agree,
really
Sphinx.
strong, and then we'd
100%.
as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market. Because the labor market, unemployment was very low, if you remember, when inflation was very high. There was a labor shortage, so we could focus entirely on inflation. Now, it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data?
Looks like we're going to get some
is
trades.
suggesting?
Oh, well, we know, I think this is, I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case,
So that's a fancy way of saying we don't know.
Job creation, in a way,
This is terrible.
Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts.
Amazon.
How much right now are you factoring in AI?
Man, that's a
into the
Midwestern
current weakness
accent
in the
right
job
there.
market?
She's from Chicago.
It's probably part of the story. It's not a big part of the story yet. We don't know whether it will be.
All right, we got our short right here.
For
Let's have a
example,
look.
if you look at,
Euro USD.
announcements of
Pretty good
layoffs
area.
and also
See how this
companies, saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect
No, unless they've already exhausted the unemployment insurance, and you know that. That's a garbage argument.
But longer term, though,
We heard
the
that
question is, what are we going to
2010 to
see here?
2016.
It may be that in past technology.
Gordon, you're long the euro. You're doing pretty well.
Technology,
I'm looking for a short scalp right here from about
innovation
160 or
eras,
117.
you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Thank you, Chair. Enda Curran, Bloomberg News. Given the
Yeah, I agree,
views
T.
on the
They've already
policy
been laid
committee,
off and past their
why is there
ability to get
such a
more
division of
unemployment.
views between
On the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade,
Solana's exploding to the top
how
side.
would you factor in
Whoever called that out was fantastic. We got on the right side of it.
The tariffs
Let's go ahead and close it.
in terms of growth and inflation. Thank you.
It's exploded to the top side. What's crypto doing?
It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so that's clearly a thing. It's also clearly a thing that, asset values, housing values.
Jason Robinson out of Idaho. Love it.
Values are high.
So no one asked about that 40 billion of QE. Why would they, Jason?
So as how sustainable it is, I don't know. Most of the
Could you explain that 40 billion a month in QE, please?
I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And,
what are those?
I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made expensive for them to move, and we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods. And we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected.
It's entrenched, and you know it.
That's
you won't raise interest rates to fight inflation. You're not going to do it.
Turns out to be more and more persistent.
We'll break this down at the end. A couple things that really jump out.
Holding back from passing through the tariffs, we'll just keep doing that. So you'll see, you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see, just traditional inflation. I don't see that as particularly likely, but so I think again, all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having, social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different
The last thing he
directions
said is very, very ugly.
But yes, that
I'll tell you why here in a minute.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming
Needs to
Fed
quit
chair,
today.
you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I mean.
Then why did you cut interest rates by a half point?
Bigger things. I have
Last
many
fall.
years ahead to worry about that.
It didn't work.
There's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time. as
He's going to
chair.
the
I
private sector.
haven't got anything new on that.
He's going to write a book.
Go to Mark for the last question.
Fantastic.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates or yields
Guy has a radio voice.
have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency
Gordon,
savings
Skynet.
challenges. Is that
Yeah,
just collateral
Skynet is
damage or
coming
an
online.
unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and
You
maximum.
could go with a
employment.
sell
Those
right
things
here
are
on gold
usually
if you
valuable
wanted
to
to. You need a little
all the
bit bigger
people we
close
serve. When we raise
beneath
rates
this
to
9
bring
EMA.
inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
All right, I have some notes. We'll get back to the tote board here in a second. We made some pretty good trades. That's a good one from T. Marine. I'm rolling out to my lavish new office at the UN to kick my feet up. That's exactly what Jay Powell's going to do. He's probably going to write a book, I would think. Take a good look at what Bernanke did. He's going to hit the speaking tour. Bernanke made a secondary career after just discussing the catastrophe of 2008 and all the different things that happened and all the TARP programs and how they really had to fight to restore the economy after that big meltdown of 2008. But the truth was they caused it. And they know they caused it because they were putting cheap money on the streets, and that was being invested in toxic assets. So when Jay Powell sits there and out of one side of his mouth, he says, well, I don't think that lower interest rates are really going to do much to impact yada, yada, yada. If you put lower interest rates on the street right now because of the economic cycle that we're in and the AI bubble that is there, that cheap money is going to go right into AI. That AI is going to go to replace human workers. So when somebody sits there with a straight face and tells me that productivity is going to go up, but job creation is probably going to go down, I don't like that at all. That's basically what you're doing is you're talking about the end of the human era. And, unfortunately, I'm selfish. I'm a human being, and I'm not a machine, and I'm not AI. So for me, it's when I hear things like that come out of policymakers, it worries me because they know that if they cut interest rates down to nothing, it's going to fuel the AI bubble even further, and the byproduct of that is going to be spiking unemployment. But productivity is going to go up, but the markets are going to go up. Well, at a base level, if nobody's got a job, who cares? What does all that stuff even mean? So I got pretty frustrated with Jay today. I don't really like to speak negatively because it doesn't get us anywhere. We're traders. We need to be upbeat and positive and as optimistic as we can be. But when I start hearing things like that, and Gordon really hit it on the head, Skynet's coming online, it all ends the same way. You guys have seen the movies. So we're either really overstating what we think AI can do and where it's going, or we are really naive and we're lambs to the slaughter. I'll leave that. That could be just up to you to make that decision. It's none of my business. The ball's already rolling. There's nothing we can do to put the rabbit back in the hat. The other thing I will say is this. The inflation problems that we're seeing, the problems in the housing market that you are seeing, are all a function of the post-COVID policies. They really are, from the Fed. When you talk about cutting interest rates to 0% during the pandemic, and then the government stimulus that came in ahead of that, and then everything else that really flooded your system with so much money that it couldn't fail, to sit around and act like that Federal Reserve didn't make those decisions and that they aren't a reason why the inflation is entrenched. Notice he didn't use the word entrenched. There's no question. Prices are higher, and they're higher to stay. They're not coming down. He needed to do what Paul Volcker did back in the late 1970s. The prime interest rate needed to go to 15 to 20%. So there was an impetus to pay back the loans that you took out at 0%. There had to be a way to take the slack out of the system. And if you didn't do that, you're going to see higher home prices. You're going to see higher prices for food, higher prices for staples. And they damn well know that. He knows that. As sure as I'm sitting here in this chair right now, Jay Powell knows that. But they won't admit it. And the fact that they won't admit it means that what? It means they're political animals. It means they care about the appearance and the perception of the Fed. The last thing I'm going to say is this. Things take time to unwind. They knew when they went unlimited quantitative easing, they had to do it to avoid a global depression. It's not much different than what happened in 2008 with TARP 1, 2, and 3, where they said we have to prop up the banks. It's too big to fail. We had to support the system or else catastrophe was going to strike. They know that. It was the same situation. The default answer in a crisis is to pump the system with liquidity and then ignore what you did and say, well, we had to do it. Okay, fine. Let's say you did have to do that. And you had to carry the economy a few rounds and you had to be dovish for a certain period of time. And all that's great. Why on earth in 2024 in September did you cut interest rates by 0.5 point? You know that was irresponsible. You knew that inflation was out of control. You did it anyways. Why'd you do it? It was right before an election. Why did you do it? Take a look at any chart out there on CPI and inflation. We're going to cover this next week when they release the CPI numbers. I'm going to go through the chart, and I'm going to show you exactly where that rate cut was, and we're going to look exactly where inflation's gone since then. They know damn good and well they jumped the gun trying to make those rate cuts. They know it. So what I want you to take away from today's meeting with Jay Powell is, number one, that man said nothing. I'm almost offended to the level of banker speak that I saw today. That is unacceptable. He's not being straight with us, and that's okay. As traders, we have to understand that, okay, they're not going to tell us what's going on because the truth. Do you remember the part where there was we have to build up our reserves going into April 15th? Well, what happens April 15th? Tax day. What do they think is going to happen tax day? Is it going to put pressure on certain regional banks? Are they keeping the supplies bigger, the stocks of capital reserves bigger to maybe bail out banks this spring? That caught my attention immediately. I went, Okay, well, if everything's so great, why do you need big reserves? And the answer is to supply liquidity to a system that may need it, or else it'll collapse. The last thing I'm going to say is this. The guy asked him about his own legacy at the Fed. Jay's answer is typical. I want to turn over a good economy. I want to turn over low inflation to the next man or woman that gets the job. Okay? Read between the lines. I don't want to go out on a recession. I don't want to be the Federal Reserve chairman that goes out on a recession. What is the one thing you're going to be able to do with interest rates? You're going to be able to cut them and support economic growth. You're going to be able to bring that employment down. But the one thing those rate cuts are going to do is they're going to create a major problem for inflation. Inflation's out, the rabbit's out of the hat, and they can't save it. And for us traders, it really spells to the top side of a lot of these markets. If you never raise interest rates and there's no grown-ups at the table, do the markets ever correct? No. Take a good look at the Nikkei. Study Japan's stock market since the year 2000. Let's see. T. Marina, you mentioned stagflation too. Well, I mean, what is stagflation? Stagflation is when inflation is high and job rates are going in the different direction. Job creation goes negative. That is stagflation. I mean, I'm getting a little fired up here, but Jesus, I mean, you got to be kidding me. That is the textbook definition of stagflation. Growing inflation, lagging employment. He basically said, well, we project a negative 20,000 contraction in jobs each month. And yeah, inflation's ticking higher and unemployment's ticking to 4.5%. Yeah, no kidding. It's called stagflation. He wouldn't dare say that word, even though that's exactly what's happening. I'm awfully concerned about next week's jobs number. I think that's the reason why they cut today, is because they know next week's jobs number is going to be an epic fail. And they also know that the inflation numbers probably aren't going to look good. Still, though, to cut interest rates given the prices, I mean, you can't sit there and say that jobs are in a good position and we're in a good position and then do something that's going to force prices higher and really hurt the folks that are actually working. It's just not a good situation. I don't think there's any way out of it. I really don't. We had a comment earlier here from Calvin, longtime trader, knows the markets very well, and says, hey, listen, we don't want the next Fed chairman to be, I think he said Hassett or whoever, because you don't really want a Trump yes man in there. And, you know, politics doesn't even matter in this equation. The bottom line is this: if you get somebody who is going to take directions from the Trump administration on interest rates, you're going to get a bunch of swift rate cuts. And the problem with swift rate cuts is that it will fuel inflation. There's no question about it. There's no question about it. So be very, very careful with who they put in there. Somebody needs to have a level head and say, we're going to have to live with rates higher for longer. Trump's not about that. They want to attempt to cut interest rates down to nothing. They want to try to grow their way out of the problem. They want to inflate away the debt. Well, who cares if we owe $40 trillion if all of a sudden our economy has grown by $80 trillion? That's the idea. That's so, well, real inflation's okay. You can still pay $50 for a rib steak at the supermarket, you know, if you're making $25 more an hour. The problem is it doesn't work like that. Wages don't go up like that. And there was another great question from T. Marina in the live chat. Shane, what happens when a country cuts its interest rates to 0%? And I said, see the COVID era. What happened during COVID? You put a ton of 0% money out there. What happened? A lot of folks bought houses with it. Okay. That's one way it can be used. How about at the commercial level? How about at the corporate level? You're going into an AI boom, and we're talking about cutting interest rates way down there. That money is going to flow into AI, and you're going to see vertical integration. I'm just telling you, the rich are going to get richer. I know that's the way of things, but 0% money makes that very possible, and it makes it almost probable. So I don't know what's going to happen. I'm betting on rate cuts. I would bet against the Fed. I'm betting on rate cuts throughout next year. I don't really see any way around it. I don't think it's responsible. I think it's going to put us in a real serious situation where inflation's entrenched, and we're going to have to take a lot of money out of the markets to give ourselves an opportunity to live, you know, just a quality of life similar to what we've lived. And I know I'm sort of an old guy. I get it. I mean, I'm 46. I've been in this a long time, and a lot of you are young and you're saying, well, what's this guy talking about? What? I don't even know. I'm not a boomer, but what am I, Generation X or Generation Z or whatever the kids call us these days? And I think it's great. I love a young pair of eyes on the situation, because as a young person, you see things and you go, well, that's not the way it should be, or that's something. That's great. And I love those opinions. As somebody who's been around a little bit in the financial markets, anytime you see a catastrophe like a COVID, and we never saw anything like it, I would equate it to 2008 to 2012 liquidity crunch. Anytime you see something like COVID, it's a crisis. Everybody gets blown out. Industries consolidate. The rich get richer. It's just the way that it is. I'm not railing against it. We just have to find a way to do it. So let me see, Lewis. I'm 46 too, Shane. We're not old yet. No, I got to go to the gym and get a little exercise and eat right, or else I look considerably older, that's for sure. So I want to thank everybody for joining me. Universal, how are you doing? I'm sorry I mentioned that. We're in an interesting situation. I think that watching from Amsterdam, good to see you, RIX. Fantastic. I've never been to Amsterdam. I actually was going to fly through there and spend a few days just to see it. I heard it was really something to see, but last trip, maybe next trip to Europe, I'll swing through Amsterdam. That's for sure. Let me see, Jason. What is a long time? What is a long time? How's that saying go? For what's a long time for anything? A fruit fly lives a day, 8 hours, 9 hours. Mountains are millions of years old. What's a long time? To me, what's a long time? That last press conference was a long time. Watching that guy stammer through and not say a damn thing for an hour. Really, I don't know what it is. Maybe I'm just a little aggro today, but I didn't like any of that. I don't like when people lie to me like that. And there's no question about what he was doing. No question about it. All right, let's get back to our Euro USD scalp. You can see our level showed up pretty well. We took a nice draw right up to right at 117. This is why I really love key levels. Don't get caught up on the dollar amounts. It's all demo. But this right here was a pretty darn good move. We sold 195s, got a nice move down to 189. That's what I call a high-impact scalp of about 5 pips. Things like that, you can make a lot of money just trading, tick scalping. We're going to do some of that tomorrow. We're going to do some of that tomorrow in the live market. I think it's going to be a lot of fun. As far as my silver trading goes, I mean, any real reason to buy a pullback, you would do. This right here broke our symmetry, so we're out of the game for the most part. Really nice signal there on the 5-minute, though, on the cross. Beautiful stuff there. The gold trade, we were sitting here looking for potentially a sell. That would have been it. Yeah, maybe that one right there would have been it on this 9 EMA. We'll talk about these strategies some other time. Whoever called out Solana and wanted me to get involved with that was pretty good. As far as our track record for today, I mean, ignore all this money because it's not real. It's demo money. I don't want to deceive anybody about exactly what we did today, but we did all right. That was a flubbed trade. We flubbed that one with the stuff. But you can see, let's see what's today, the 10th. So you'd have won a little bit there, got a little bit there, got some there. That was a dummy trade. We had to close that out because the leverage was wrong. This one right here was a pretty good trade, though. That was the trade on the US 100 was really an accurate portrayal of what you can do in the markets. That was a legit trade, looking for about a $900 gain. That kind of trade right there was a absolute spitting image of what you can do with a crossover strategy on like a prop account. If you're saying, geez, Shane, I could never trade my own money looking for $900 like that. Yeah, but you could with a prop account. Think about it. If you're with a $100,000 prop account, what are you really looking to do there? You're trying to make 1%. Hell, that's doable. I mean, that's money management there. So you can definitely do that. Let me see. Shane, you're incredible. I don't know. Oh, Jason, hi. You said you've been doing this a long time, about 15 years, Jason. When I first started here, I said 10. I said 10 years, and I've been here 4 years now already. And so we're right at 15. I started in 2011, and I've been around ever since. Seen a lot of things, but just because you've been in the market a long time doesn't make you, great at this. There's young hotshots out there that are damn good at what they do, and I respect the craft. I don't agree with a lot of the risks they take because eventually the risks come and get you. Believe me, did it in real estate. When the time's up and the risk gets the best of you, man, it's painful. Maybe I'll just do a live stream on that one time, talk about exactly what it's like to lose financially and then rebound and build back, because I know a lot of you are in the same position. I know that. Let me see. Let me see. Universal, you look chill, pal. How was your trip, and does it really affect trading psychology for intermediary traders? Yeah, I mean, time off definitely impacts your trading psychology. I'm slow to get back into it. It takes me, well, let's see. I mean, the trip overseas to Greece back this last fall was great. It took me a while to get back into it. Off a few days the other week, and really slowing down this time of year. That's a challenge just to get back in the saddle. But I'm gonna have some time off coming up here in a few weeks, and I'm actually gonna be away from the screens for a couple of weeks. It's gonna take me probably a good 5 to 8 days, 8 sessions, maybe a little bit longer to get dialed in for the new year. So I definitely will not be rushing in. January 2nd, we're gonna be streaming. I'm not gonna be guns blazing. It's going to be a little bit different. We're going to see. Let me see. What's the name of this demo, F? Yeah, F. This is just TradingView. I just run TradingView demo. And I like to do that to illustrate trades. Tomorrow, though, probably going to be doing some live prop trading with our tick scalping webinar. So don't miss that. That's over on Switch Markets on YouTube or in the How to Trade Trading Room. Check us out on the Switch Markets YouTube channel, though. I'm going to be, it's a race to 10. I'm going to pick my markets probably in the hour before. I'll tell you exactly which markets I'm going to trade, and I'm going to tell you exactly what our risk parameters are and what our profit targets are. We hit 9 last time. We'll hit 10 tomorrow. I'm pretty confident of it, especially if the market slows down a little bit. We're going to nail it. We'll do it, though. Probably futures contracts. We'll do a little. It's too hard to get these these Forex pairs to move as fast as we need them to move, but we might do some. Well, yeah, we'll get some majors in there. I want to look at the Swissy tomorrow. We might get a great trade in the Swissy because the Swissy has got the SNB during the overnight, and they're going to make their interest rate decision, and they're going to probably going to laugh at Jay Powell and go, look, this guy says nothing. You ever wonder if he's the laughing stock in the central bankers' rooms? I see the only mature people at the table right now are the folks that are holding their rates static, or Japan's talking about raising interest rates. That's how serious the inflationary problem is globally. All right, a couple more questions, and then I'm going to go ahead and sign off. We've been rolling here for about an hour 20. Let me see, Lebo. What is a positive win-lose ratio? I understand that if you lose 7 out of 10 trades, but the 3 out of 10 trades you do win will make up for all the losses of the 7 out of 10. Is that a positive win? Well, here's the thing. A positive risk versus reward ratio is basically one that you're profitable with. That gives you a per trade positive expectancy. That means that if you lose 7 out of 10, but you win 30% of the time, and your risk versus reward is like a 1 to 5 or a 1 to 6, I'm not sure exactly what it is, 1 to 5 or a 1 to 6, right? The money that you make would be divided up by all 10 trades. So let's say you're profitable using a 1 to 6 risk versus reward, and you only win 3 out of 10 trades. Your per trade expectancy is going to be, what is it? It's going to be 500 divided by 10, which is going to be what, about $50. So every time we take a trade, we expect to average a $50 profit over the long haul. That would be a positive trade expectancy, and your risk versus reward would be positive. Now, here's the thing. I always say if it makes money, it's the right answer. So if you're trading 10x trades, 1 to 10, whatever, and you're only winning 2 out of 10 trades and you're making money, great. God bless you. Run with it. Make a fortune. Buy the Ferraris. Get the private jets. Do whatever you want. I'm never going to sit there and say you're doing it wrong. I'm not going to say that. What I am going to say is with a 20 or 30% win rate, even though over the long run you may be profitable, don't forget your consecutive losses. If you're losing 7 out of 10 trades, there's a real good chance you could start losing 10 and 15 trades in a row before you get hot and win 6. If you lose a lot of trades in a row, you're going to lose all your money and you're not going to be able to trade anymore. That's why I'm a big 1 to 1, 1 to 2, 1 to 3 guy. I want my winning rate to always be around 60 to 70%. Now, is that possible? We showed you today that it's possible. It's very possible. The real question is how do you want to build your own trading? That's up to you. If you want to take big moves, take the big moves, the big winners. 7 out of 10 or 3 out of 10 is probably good enough. Just make sure you study your losses. How many losses in a row have I ever got doing this? Because when times go bad, it's about holding on to your money. Very, very important point, Lebo, and great question. Let me see. TM, Shane, are you doing the Leap Christmas edition completion? Yeah, I'm doing it. I'm getting slaughtered, though. Right now, I think I wanted the big profit targets, T. So to try to win a contest like that, I'm not interested in just making a little bit of money. We just did that. We can sit there and scalp. We're going to do it tomorrow. I'm not going to sit here and scalp my way and try to, put 50 or 60 man hours into winning the contest. I'm not going to do that. What I am going to do is I'm going to look for the highest, the biggest potential trades and take them. So I had a position in soybeans that was pretty good. It reversed on me. I have positions basically against the metals markets today, especially against silver. I'm getting eaten up there, but you could see a big reversal there. So that's what sort of I'm looking at there. I am bullish stocks, so those are all up. Those are doing very well today. So yeah, I'm in it, but I'm not really putting much time into it. To answer your question, just why spend 40 hours to try to get a free subscription to TradingView? I'm not interested. Subscription costs already figured and cooked into my books. All right, guys, I'm going to go ahead and sign off. I hope I answered everybody's questions. I got to quit saying hope, but Jay Powell said hope in his presser. That's just what you want, the leader of the financial world talking about hope. Unreal. Absolutely unreal. All right, guys, I'm going to sign off here. We're going to be back tomorrow with some live tick scalping. A lot going on in the markets next week. I'm going to go ahead and get that streaming schedule up for you over at How to Trade probably in the next 10 hours or so. We got to see. Also got videos dropping. Another one drops tomorrow on Switch Markets TV on YouTube. Check that out. You're definitely going to want to tune into those. We had a couple pretty good videos out. Basically, nobody's watching them. That's cool. You don't have to watch them if you don't want. But like if you want to learn how to trade the S&P 500, put a video out last week that nobody watched. It can help you get up and running with it for if you're a beginner. Also, if you have any questions at all, be sure to reach out to me over at How to Trade directly. Click on my picture, send a message, and I'm in. And always remember that if you're a new trader or a veteran trader and you're looking for market access, you're going to want to head on over to switchmarkets.com, bring your ambition into focus. They've got you covered. If you're in a municipality that they service, which is not in the United States, unfortunately, at least not yet. All right, everybody. I'm going to sign off. I'm confident that we've delivered a pretty good analysis today. I don't know. I don't like it when people sit there and try to put one over on me. And I watched Jay Powell dive into a discussion of reverse overnight repo operations that nobody understood, that I don't even think he understands. But the idea was to confuse all of us, and it was to put us on our back foot because we can see what's happening. We have a feeling the job situation is deteriorating. We have a feeling that inflation is ticking higher. So we saw a person that said, we don't have any government data. How can we make great decisions? The tariff cost, the tariff pass-through is killing us. It derailed all our plans. Saw a lot of excuses today. It was very disheartening. We did try to keep it upbeat and positive, but I have to tell you, moving forward, we have got to see stronger moves out of the Fed. And it can't always be, well, we're in a good position, because they're not in a good position. Inflation ticks higher every month. They're not in a good position. We're going to need to see some transparency. And what we saw today, as soon as we got into the reverse repo operations, I was like, okay, whatever. Basically, he was trying to explain to us brain surgery, when all we wanted to know is, is my arm broken or not? That's it. Something to think about there. All right, guys, I'm going to go ahead and let me see. Lebo, is Switch Markets on TradingView? I haven't used MetaTrader in ages. Yeah, I try to focus all the analytics on TradingView because it's easy and I can move fast. MT5 as an order entry platform is great, though. It's an older platform, but it can get the job done. What you can do is you can go to Switch and use Pine Connector and link TradingView directly to your MT5, and everything will flow right in there, and you'll get your trades executed lightning fast. We made a video on it. Check out the Switch Markets YouTube channel. Also, if you're interested in Pine Connector and getting it set up reach out to the support staff over at Switch Markets. They will get you up and running relatively quickly. T. Marina, will you be posting new content on there? Yeah, the new content's over at Switch Markets on YouTube. So definitely check that channel out. We're streaming live there as well, but also you're going to want to check that out for the new stuff. All right, everybody, that's a wrap for me today. I've gone way too long. You have a fantastic trading session. We're going to do some high-impact tick scalping tomorrow. I can't wait. I'll probably do some push-ups, maybe do a little cardio before we get in there and get it on, but I'm looking forward to the challenge. We're going to make 10 ticks in 30 minutes. Positive. Remember, the best trades are always tomorrow. The best trades are always tomorrow. The best trades are always tomorrow. Have a fantastic trading day. Trade the action well, and we'll talk soon. See you.